Hi everybody, and welcome back to our last video, video number 9 in chapter 21. And we had just finished, when we left off, this illustration of the investor company. And so, as we move forward, assuming a change from the equity method to the fair value method as of January 2nd, 2025, investor company's reported investment in investment company and its reported income is as follows. And so here we show the dividend revenues recognized here, and here for 2025, 2026, and 2027. And then we show the cumulative excess of share of earnings over dividends received here of 200,000, 150,000, and a negative 60,000. And how we get this is explained here. The 200,000 here is the 600,000 minus 400,000. The 150,000 is the 350,000 minus 400,000 plus the 200,000. And then finally, for Charlie here, the negative 60,000 is this 150,000 minus 210,000. And I think we got to go back to this schedule here to see where all those numbers came from. Okay. Now, for the investment at December 31, we had 8,780,000 in 2025, and we had $8,780,000 in 2026, and then we had to subtract $60,000 here to get to 8,720,000 for 2027. So we would record this dividends and earnings data for investor company for the 3 years subsequent to the change in method as shown by these entries. In 2025 and 2026, we debit cash for 400,000 and credit dividend revenue for 400,000. And that's to record the dividend received from investee company. Now in 2027, we're going to debit cash for 210,000, credit equity investments, reduce equity investments by 60,000, and record dividend revenue of $150,000. Okay, that's going to record the dividend revenue of investee company in 2027, and to recognize the cumulative excess of dividends received over the share of investee earnings in periods subsequent to change from the equity method. That's quite an explanation. So you have to go back to these pages to see how those numbers came about. Okay, when we change to the equity method, companies use the prospective approach. Under this approach, the companies do not adjust opening balances to reflect the change in principal on prior reported results. Instead, they account for the effects of the change. Number one, the period of the change, if the change affects that period only. Or two, the period of the change and the future periods if the change affects both. For example, here, the Acctg technology on January 1, 2025 purchases 10% stock interest in Cellular 4D that costs $850,000. Acctg technology uses the fair value method to account for its interest in Cellular 4D by adjusting its cost basis to fair value at the end of the reporting period. So the journal entries here to record the purchase of cellular 4D on January 1, 2025, we're going to debit equity investments here for $850,000 and credit cash to pay for that $850,000. At December 31, 2025, the fair value of Acctg Technologies investment is $1 million. The entry to record the excess of the fair value over its costs for Acctg Technology investment is as follows. So we'll make a debit to fair value adjustment here for $150,000, the difference between $850,000 and $1 million, and an unrealized holding gain of $150,000. So now on January 1, 2026, they purchase an additional 20% of stock interest in Cellular 4D for $4 million. Because of this additional investment, Acctg Technology now exerts significant influence over the operations of Cellular 4D. Acctg Technology must use the equity method to account for this investment. Acctg Technology adds the cost of acquiring the additional interest in Cellular 4D of $4 million to its original cost basis of $850,000 to determine a new cost basis in Cellular 4D of $4,850,000. Acctg Technology makes the following entry to record this additional investment. It'll debit equity investment here for $4 million and credit cash. Okay. And then additionally, it's going to debit equity investment in Cellular 4D for $850,000 and credit equity investments of $850,000. And then in addition, it must adjust the fair value accounts when it changes to the equity method. And the entry to record that transaction will be a debit to retained earnings and a credit to fair value adjustment for $150,000. Therefore, Acctg Technology now reports an equity investment of $4,850,000. Subsequently, Acctg Technology will adjust the cost basis of $4,850,000 for changes in the net income and dividends of Cellular 4D under the equity method as discussed in Chapter 16. Okay, let's take a look at the differences between GAAP and IFRS for accounting changes and error analysis. Here, similarities with IRS. The accounting for changes in estimates is similar between GAAP and IFRS. Under GAAP and IFRS, if determining the effect of change in accounting policy is considered impracticable, then the company should report the effect of the change in the period in which it believes it practicable to do so, which may be the current period. The differences, we have several here. One area in which GAAP and IFRS differ is the reporting of error corrections in previously issued financial statements. While both sets of standards require restatement, GAAP is the absolute standard. That is, there is no exception to this rule. Number two, under IFRS, the impracticality exception applies both to changes in accounting principles and to the correction of errors. Under GAAP, this exception applies only to changes in accounting principle. And then number three, IFRS under IAS 8 does not specifically address the accounting and reporting for indirect effects of changes in accounting principles. As indicated in the chapter, GAAP has detailed guidance on accounting and reporting of indirect effects. Well, that ends chapter 21. And when we continue, we will move on to chapter 22. Until that time, bye for now.